there is a question that I've been thinking about lately, and that is saving or investing enough to get you out of the rat race? I need to break down all of these different things. Now, of course, I'm not going to give you like some crazy stats or whatever it may be. These are just my thoughts. So, obviously, listen and watch with caution and do your own research. But these are my ideas, at least, anyway. So, when we think about saving, saving is the ability to put money aside on a regular basis in the event of an emergency or for a specific cause or whatever it may be. So that's why we save. And so it's a tool that we utilize when we're planning and thinking about our future. It's a just in case mechanism. It is also an opportunity for us to again have a bit of a cushion. So psychologically, we feel safe about what it is that we're doing day to day, week to week, month to month, etc., etc. When it comes to investing, it's the same principle. However, the vehicle that you use enables you to make more money, or at least that is the aim. However, it does depend on the market. Now, in many ways, you could argue it all depends on the market, but I'll talk more about that in a second. But what I mean by that is, depending on what vehicle you're using to put your money in, that will determine whether you make more, lose money, or it's quite steady in by nature, so to speak. But again, there is this regularity thing that we need to think about. Now, when we think about the rat race, what is the rat race? This is the idea that we are rats on a wheel, just essentially chasing a cheese that we're never going to get. That cheese being financial freedom, a sense of well being, deeper connection with family, because of the fact that we have the money to allow us to do what we need to do. So that's breaking it down. Now, of course, when we think about savings accounts versus, some sort of investment vehicle, we have to think about interest rates, okay, as one a thing at least anyway. What do I mean by this? Depending on where you're putting your money into, as a savings account, that will determine how much interest is accumulated over time. So if it's just a standard savings account, there may be 0% interest, there may be 2% interest, there may be 0.5% interest. But if it is an ISA, which is a vehicle that is tax free, I think up until 20K, until further notice of this video, of course, then that enables you to actually increase your savings, so to speak, based on what the national interest rate is at the time. Now, of course, banks will change it according to, bank preferences, but essentially it is affected by things like inflation, the Bank of England interest rates as well, which I believe is currently 4% or so. And then there's also the gilts market or the bonds market, which determines things like mortgage rates, what the Bank of England are going to do, etc., etc. It's essentially how the big top investors really react to the market when certain political decisions are made, policies are put in place, and all of that kind of stuff there. So it's pretty much in line with that stuff there. So you may be thinking about a cash ISA when it comes to trading 212 or Halifax or whatever it may be. So that's savings aside when it comes to interest rates. When it comes to investing, well, there are many different ways to think about it. If you're more of a proactive investor where you are timing the market, you're looking at specific, I can't even talk properly, stocks. Let's say you're looking at some tech stocks because, again, maybe there's an inflationary sort of like environment in relation to tech stocks right now or something else. Your margins are going to be bigger. Okay, but of course, it also means that you may lose a lot of money as well. So it may appreciate quickly or depreciate quickly. Now, if you're thinking purely about safer sort of like investments when it comes to things like the S&P 500, which is essentially the top 500 performing companies registered within the US. It's also the FTSE 100. That's the same thing, but the top 100 within the UK doesn't perform as well since 2009, I want to say, which is where the housing crisis happened. Then you'll see an increase in your money potentially over time, anywhere between, let's say, 4 to 12%, okay, depending on what it is. But notably, the top 10 of those stocks, or the top even five of those stocks, or top seven, are the Magic Seven stocks. So that is Amazon, Facebook, Google, Apple. I think Nvidia is one of them, etc., etc. Tesla. I think there's one more. I may have got this wrong, but you can check this out for yourself. So there are different ways in which you can apportion a pie. You could go down the route of actually, I'm going to be stock heavy and aim to increase my portfolio by 50% or 70% year on year, bearing in mind that I know that actually I'm going to have to manage the shakiness of the market going down and up depending on different political factors. But two, there's also the slower but more steady and more proven, should we say, or evidence, should we say, rather than proven, over the last 100 years that there is likely going to be an increase when it comes to things like S&P 500. But you just never know. You just never know. It's a risk in itself. And so whether you're going down the proactive investing route or going down the more less proactive rather than passive, because you have to do a bit of work, then that really begs the question. And so really what I'm saying is you could increase your earnings from saving or investing conservatively anywhere between, let's say, currently as it stands, savings wise, 4% to as high as 12% if you're using an index. But then if you're proactive, there is more risk where you could make more, but then that requires you to be more on it in terms of reading charts effectively well. So that is your technical analysis, fundamental analysis, understanding what's happening in the news, okay, in relation to that industry that you're looking at that affects that stock. Is also looking at geopolitical factors. How is the economy affecting things in general, and also having a bit of intuition, so to speak, like what are like based on all of the information that you've developed and gathered, what is it telling you? And so you need to get the right sources of information and have a scorecard for making those decisions if you're being more proactive when it comes to being more proactive with investing in stocks, etc., etc. But these are decisions you have to make. Now, what do I personally do? I don't like to be too risky. I don't have individual stocks per se, but I do. I say trade. I invest using index funds and also ETFs. So there will be tech heavy ones. There'll be the S&P 500. There'll be emerging markets, and there'll be gold and a few other stuff as well. There are some rules in terms of what people suggest. If you are 20, then they're saying you can invest in things that are more stock heavy and all of that kind of stuff there. If you're like in your 30s, a little bit of stocks, a little bit of ETFs index, and like small amount of bonds. And then as you get older, you're going to be a bit more safer. There is a rule for this, but I'm not the person to ask because I'm not a financial advisor. So you can speak to those people who can advise you on that stuff. So hopefully this gives you a bit of an idea between whether saving or investing will get you out of the rat race. The answer to that really comes down to who you are as a person, okay? And it comes down to some of the following factors. And I want to come to my notes here to support me with this. Now, if the goal is to achieve financial independence, okay, because there are different levels. I think there's like, I would call it like financial negligence. Then there's financial stability. Then there's almost like financial independence. And then there's financial freedom. I'd probably sort of list it like that. And so when we're thinking about, all these different levels, this really comes down to something very simple: profit and loss. I don't know if you've ever heard of a P&L. Some of you probably have. But how much do you make and how much do you lose, so to speak? Or you could see it like this: how much income do you generate and what do your expenses look like? It always comes down to that. So let's break this down. If your expenses are high, okay, so we know expenses come in a form of taxes, which are either taken out straight away for an employee, or you have to manage yourself if you're working under a limited company, as an example. So there's taxes to consider. So PAYE taxes, corporation tax, VAT liabilities, all of that kind of stuff there. So you're taking all that off. Then you've also got things when it comes to bills and subscriptions and things related to lifestyle. That's another expense. Okay. So these are all things related to expenses that fund your life, so to speak, allow you to do the things that you want to do or have privileges to obtain, such as the NHS, X, Y, and Z. I know there's a whole argument around that, so I'll leave that for you guys to talk on. But whether I say that loosely or very poignantly, the point being made is that there are expenses. And so there's only so much like expenses you can cut. You can cut, but to what point? There, it gets to a point where it's like actually it affects who you are as a person, it affects what you can do, it affects how you feel, all of this kind of jazz there. So what's the alternative? Well, the alternative is you make more money. And I say like, oh yeah, that's a simple idea. But we've come to a point where it's like finding a job is so difficult. I think I keep on quoting the same numbers, and I probably need to do research to find new numbers. But I know for July, at least, the last 12 months, 164,000 jobs less than we had 12 months before. And so we're in a certain time. Yes, I think I've read that jobs are increasing in terms of numbers, but lo and behold, that's heavily within the public sector, and that's heavily within health and social care and education, the areas that this current government is pushing, at least within the UK. And so it's not even Stevens for everyone. But in terms of making more money, that comes down to getting a pay rise, getting a promotion, finding a new job, doing a side gig that could be an outside of I-35 contract, that could be a freelance thing. This could be something based on your current skills and doing something like Fiverr or Upwork or whatever it may be. Or you could start to build your business a certain way, your side hustle, whatever it may be, coaching, this, that, X, Y, and Z. It may be a little, maybe a lot. And of course, if it's something where you are exchanging skills that you've developed in your professional experience for outside of your current employment, then you're more likely going to make money because there's more trust. There's less of a learning curve, there's less of all of that stuff there. But if it's something that you're building and all that kind of jazz there, it takes time. It takes time to do this stuff. Why am I saying this stuff? I'm trying to highlight to you it's requires some sort of income and requires some sort of management of expenses to determine whether you can actually put money aside to save and invest. Of course, if you are using the FI model, what does that stand for again? I think it's Financial Independence Retire Early. I think that's what it stands for. They utilize the 4% rule. And the whole idea is that if you can comfortably withdraw 4% of your investment, then you're pretty much financially free. Why did they come up with the number 4%? Well, if you, I think I've got the maths right, so you have to correct me if I'm wrong. But if you divide any figure by 4%, and that number is basically the annual amount that you will spend each year, then that is essentially telling you that you can survive for the next 25 years without any additional monies. So let's actually use an example. If I know I need £40,000 cash net to survive every single year, then in order to work out how much I need in my investment to withdraw 4% each year, then I would do 40,000 times by 25, which is £1 million. £1 million. And so that is basically telling me that I need to save £1 million in order for me to withdraw 4% of that money. Now, some of you are thinking, well, that's not for the average person. How am I going to put £1 million into some sort of investment fund or savings account or whatever it may be? Can I do that on my current salary? If I'm only able to put away £100, £200, £500, maybe even £1,000, how long is that going to take me? Well, I know if it's £1,000, that's going to take 1,000 months. And I can't do the quick maths right now, but 1,000 months is 1,000 months. It is what it is. I think I've got that correct at least anyway. And so it becomes a bit disheartening. It's like, oh, can I really do that? That's assuming if there is no investment vehicle that you're using. So this is for option A, the savings element. If it's option B, then it's harder to calculate because you can't necessarily determine what that interest rate looks like. And if I was, again, going with option A, the savings sort of like solution, then I'd be assuming a certain interest rate of like 2% at a minimum because we don't know what's going to happen in the markets. And so this is all to say, yes, savings and investments can help you achieve financial freedom and get you out of the rat race, but only if you have the capital and or dollar cost averaging, i.e. the amounts you put away every single month, the same amount you put away every single month to afford you to do that in a fashion that you're comfortable with. No savings or investments is comfortable, none of it. None of it. This is a minimum 5 year plan to like 20 year plan. And nobody wants to hear that in this current economy. And so this is why we start getting pushed towards the idea of business, portfolio careers, entrepreneurship, consulting, all of this kind of stuff that can generate the income. And so the other side of it is lifestyle inflation. We put ourselves in situations where actually we spend more, we make more, we spend more. So unless you're super disciplined and you can do this whole delayed gratification thing where you're not trying to take, minute rice out after like 10 seconds, that would be mushy rice anyway, that's disgusting. Then it can't help you. It can't help you. It's not to say that you shouldn't do it, but if we're talking about the short term and the medium term, it's not going to help you. If we're talking about the long term, it's going to help you. So you have to have a long term mindset and think for the short and medium term, what can I do to generate additional income that is sustainable? This is where Daniel Priestley talks about a lifestyle business. This is where I talk about the portfolio career. This is where other people talk about other ways in which you can make money. But stick with one way, stay consistent with it, and then you can put those additional incomes into your pot if you need to, or to support your lifestyle, whatever you decide to do. This really comes down to maths, and this really comes down to understanding what you can provide and learn, and this also comes down to opportunities as well. So hopefully I've answered the question. I'd love to know your thoughts. Do you think savings and or investing is enough to get you out of the rat race? What does that actually mean? Leave your comments below, and of course, if you want to see more videos centered around portfolio careers, contracting, and all of this kind of stuff, don't forget to like and subscribe and hit the notification bell. And as always, my friends, understand, reach, and expand. Peace.